Good morning. This is an audio update of the stock market. It's a morning brief, no video update today. It is December 14th. It is 8:27 a.m. Eastern Time. Welcome to Critical Point Podcast. All right. I got excellent feedback over the weekend of last week's weekly update in the stock market. I may put that up for free today or sometime this week. If so, please pass it on to others. Pass the link on. If you want to copy it, it's fine, but please cite it. Now, later in this audio, I'm going to discuss some long-term statistics I think you'll find interesting. But first, let's move to the other side of the spectrum, the very short term, the level 4 intraweek to intraday type swings. The model suggesting the overnight rally stayed up for too long, and this shows two scenarios that the market's likely to remain firm to higher into tomorrow. One, the third scenario is actually higher into at least Tuesday overnight, if not Wednesday, but that would allow for level 4 pullback along the way, although it's possible we will barely see it. Okay, it'll just be minor, won't work that well. Now, of course, one scenario is that we're really not contemplating at the moment is that maybe the model's wrong and the market just peaked later than normal and they will sell it today. But basically, I'm going with a thumbs up, a bullish scenario here, at least into tomorrow for the stock market. Now we have a gap higher, so it's quite possible sometime this week they're going to pull it back to fill the gap, and we're also, of course, going to get a gap in the cash market. Now the news or the reason behind the rally is one, they were going to buy anyways. So at least technical buying, at least some kind of behavior there buying where they didn't need the news, they were going to buy anyways. That's the level 4. But likely what they're doing is hopeful for a stimulus package this week, okay? And so they're saying buy as early as possible and then manage your risk later relative to that news. They're also mindful of the vaccinations beginning today and hopeful of that is a positive development. Now, as we zoom out, the level 3 trend, well, we have a critical point now for the level 3 trend that it's probably bottomed Friday or will bottom sometime this week. As we zoom out to the intermediate intra-year trends, for those of you who are just followers and listening to this, become a subscriber, see what's going on with these weekly updates and the intra-week updates, because we do have a level 2 critical point now. And the forecast into January, February for level 2, level 1 trends remains intact. Okay. Now let's zoom out to the long term. And what we find is that, yes, we should be in a bull market this decade, but we will be mindful of any disruption, and the model will hopefully pick that up. We think there's 16 to 24 long-term buy opportunities. 3 to 5 of those should be more important than the others, as they will be a minor cyclical downturn. And it's possible one should take a little profit then at that time and then buy. Now, we believe a minor phase of this bull market this decade is that the 2021 year should be a bull market year. Okay. Now, let's look at some of the statistics here. I found something interesting on the presidential term from 1980 to current. I took the presidential term using the January close of the first year that the president would be in office and took it to the close of the following year. And what I found was that the Republicans had quite a bit more time in the White House than the Democrats. I found the Republican performance was minus 30% to minus 13% to a positive 70% or so. The average came in at about 29% profit per presidential term under the Republican, and I also summed them up for a little bit of a quirky way of looking at it, and it came up at around 174 or something like that. So for the Democrats, the range was positive 53% to over 80%. The average came in at around 70%, and the sum came in at like 280, 270, a huge difference compared to the Republicans. Why is that? And it turns out Republicans are poor timers, that they get into office when it's time for a recession and a 9-year or juggler business cycle downturn, okay, a bear market. If Republicans were already in office before then, it appears that they come in near the peak of the cycle when the economy wants to start turning down, and they do whatever possible to push the economy more than they really should, and then we get even a worse recession fallback. So we're not seeing the evidence of Republican presidents being in good line with economic fluctuation since 1980, and we're not seeing where it really works that well. And here we've had all this conservative republicanism, capitalism type momentum here, movement since 1980, and it's not really adding up to such a great return in the stock market. And I've been saying for a while that it's possible the stock market does better under Republicans and the economy does better in the Democrats, and the stock market has a disconnect to the economy. And now I can see, no, it really doesn't have that kind of disconnect, and it actually on a percentage basis does better under Democrats. So if we take a minimum of 53% and add it to, say, 3,600 in the S&P 500, I think we come up with like 5,500, which is better than what I've been thinking over the next 4 years. And that could just be the minimum return. It could be much better than that. Now, there is a tendency for the better returns to show up actually in the second term of a president. So we want to consider that as well. Okay, so that's my little long-term statistical idea this morning, and I am still a long-term bull. And at any rate, for those of you who don't understand what I'm talking about for this level 2 critical point and the forecast in January, February, take a look at the subscribing so you can get the latest details. But also keep an eye out that if I put that last week's update, weekly update, up, that you're going to find a huge amount of information in that podcast. And please share it with others. Tell people to become at least a follower, if not a subscriber. Thank you and have a great day. Manage your risk relative to analysis of others.